The broadcast is now starting. All attendees are in listen-only mode.
Well, good afternoon, everyone, and welcome to today's webinar. My name is Mike Carnes. I'm a technology commercialization counselor and equity funding specialist for the North Carolina Small Business and Technology Development Center. For those of you who don't know the SBTDC, we're an economic development organization in the state that's partially funded by the Small Business Administration on the federal level with matching funds to the state of North Carolina. Our goal as an organization is to provide one-on-one business counseling and support to companies as they grow and have an economic impact in the state of North Carolina. I'm part of a specialized team within the SBTDC called the Technology Commercialization Team, and our role is to work with growth-oriented companies that are raising research and development and commercialization capital for innovative ideas. I'm pleased today to be able to introduce two of the real thought leaders in the early stage investing landscape in our region, Eva Doss and Mark Friedman. In addition to the roles that they have within their own organizations and the leadership roles that they play there, they're both actively engaged within the National Angel Capital Association. And they have great perspective on what's happening not only here in the Southeast, but also on a national level. So with that, I'd like to introduce both of you, welcome you, and ask maybe Eva if you could start out by providing a brief introduction to yourself, the launch place, and your activities there.
Well, thank you, Mike. I really appreciate the invitation and reaching out to me to participate on this webinar. I'm the president and CEO of the Launch Place, and I'm very happy to be here. The Launch Place is a venture development organization with offices in Danville, Virginia, and in the Research Triangle Park in North Carolina. We are a dual bottom line angel fund, which means that we invest in early stage companies that can provide ROI for our investments, but also create economic impact in our region. We have two separate funds, a pre-seed fund that's tailored towards very early stage companies that might not even have a minimum viable product, or they might need further business plan refinement, establishing market traction, and we are willing to invest anywhere from $25,000 to $75,000 through our pre-seed fund to those very early stage companies. And throughout, because of our investment, we request the companies to achieve very specific milestones. And once they do that, and the milestones are achieved with positive results, they can also pitch to our seed fund. The seed fund is a larger fund, and we invest anywhere from $100,000 to $250,000 first check in. However, we always set aside dry powder to carry on investing in future rounds or providing bridge loans or bridge investments to our portfolios. The majority of our deal flow is coming from the Research Triangle Park, but we also very closely work with our other syndication partners throughout the Southeast. We are members of RTP Capital, Venture South, and we also syndicate and put deals together either as a lead or as a follow-on investment with other funds and networks throughout the Southeast. And I'm very happy to be here.
Thanks, Eva. Mark, could you give us an overview of RTP Capital?
Sure, and I want to echo what Eva said. Thanks for putting this together. I think it's very useful in times like this to be able to get voices out to people and let them hear all kinds of different perspectives on what's going on, or at least what different people think is going on. And the role SBTDC has been playing through this whole crisis has been really phenomenal. So we're glad to be part of that and working with you on this. So I'm going to say, first of all, I wear dual hats. In addition to my role as president of RTP Capital, I also work with the Launch Place as portfolio manager there. In my comments today, I'll keep them mostly to RTP Capital because Eva will be talking about the Launch Place's perspective on different things. But Eva and I work together very closely on a lot of different things. As Eva mentioned, she's a member of RTP Capital. One of the things we'll talk about undoubtedly is the relationship that all of the different investment entities in the area, all the way up to Danville and into Virginia, have with each other, and the role of syndication among the various groups. But RTP Capital itself is an angel investor network that's different than a fund, in that our members, which we have about 60 members, make individual investment decisions on companies that come in to present to RTP Capital. And we look at a wide variety of different companies, many of them the same as the Launch Place looks at. And if we have a significant number of members who are interested, we'll launch our own diligence. Very often with some of the other groups, proceed to diligence, present that diligence back to our group. And if there's an interest among members, they write a check. I know one of the things you want to talk about is differences between funds and networks, especially in times like we're in today. But the primary difference is that a fund typically has a set amount that they're going to invest. For a network, it depends on how many members are interested. So we may have a company that we have one member at $10,000 interested, or we may have a company that has 20 members with several $100,000 of interest. So it all depends on the interest of the members, and we'll get into that a little bit more, I'm sure, Mike.
Yeah, outstanding. Well, thanks for the introductions and for the some of the basics and the logistics of raising capital. So we appreciate that. So for today, I thought it'd be important to start out by giving a little context and the reason for this webinar. So over the past few weeks, we've been assisting a lot of companies who are trying to navigate the uncertain funding landscape right now. We've had many questions about equity investing and what's actually happening with investors at this time and what the opportunities for companies might be. So we wanted to get everybody together in one room and provide an opportunity to get an update to companies and get a forum for you to ask questions of investors. So the format for this webinar is that I'm going to provide a brief update based on what we're seeing and hearing at the SBTDC, and then we're going to get right into our investor Q&A. So I can already see that folks are entering questions along the right-hand side of their screen, but continue to do that as we talk, and we'll do our best to get to all the questions. We've got a lot of people on this webinar, so we probably won't be able to get to all of them, and if we don't, then we'll make sure to make an effort to follow up with you afterwards. So let's discuss the funding landscape. As tech companies in our region and in North Carolina typically begin to grow and gain traction, it's common for them to begin seeking equity financing to help with growth. For the most part, angel investors provide the earliest stage capital, not venture capitalists. This is important, and you may know the difference between these types of investors, but I don't think everyone on this webinar will. So we did want to just give a quick overview of the key differences between angel investors and venture capitalists. So as Mark mentioned, angel investors invest their own money into companies. They sometimes invest individually or sometimes in groups. North Carolina has about 20 active angel groups, and they often do, as Mark said, syndicate together with their investment opportunities. So they come together to screen opportunities and then co-invest into companies. I think we can be pretty proud of our angel investment community in our region. The typical deals that angel investors participate in are in that pre-seed and seed stage level. Companies usually raise about $1 million in that seed stage from angel investors as they come together to invest in a company. And it's important to note that about 73% of the time, companies that raise angel capitals will already be generating revenue. This is different than the venture capital community. VCs, instead of investing their own money into your company, are going out and raising a fund from limited partners. Those are institutions who want to invest a portion of their capital into a high risk asset class with the expectation of getting a return on that investment. Venture capitalists typically invest in later stage opportunities. Those are going to be companies that are raising between $6 and $10 million or more. If you want to learn more about the equity investing landscape, how to raise capital, the process of raising capital, then I would invite you to participate in one of our upcoming Becoming an Investor Ready Entrepreneur events, the SBTDC. We do several of these around the state every year. Recently, North Carolina has experienced record-breaking levels of equity funding. It's been a great time for companies that are raising capital. But now that we have economic uncertainty, this typically will disrupt the investing world. In times of recession, if you look back, investing activity usually decreases. And what I'm hearing from investors is that they expect funding to dry up for probably 3 to 6 months, best case, but it could be a couple of years before we really return to normalcy. And you may ask, what are some of the key factors that are driving this decrease in investing activity? Venture capitalists, for a large part, are currently focusing on their own portfolio companies, and they're reserving dry powder or cash to invest in the companies that they currently have that are trying to weather this economic downturn. That's going to create a situation where they're hesitant to invest in new companies, and they're going to be likely less optimistic about taking on additional risk in this environment. Another factor affecting venture capitalists is their hesitation to make capital calls right now, or asking their limited partners to provide additional capital to invest into companies. All this is going to have an impact on the angel investment community as well. Angel portfolio companies that are going out to raise follow-on capital, I'm sure you're going to hear about that from our panelists here in a moment, are having trouble finding that next round of capital, and at best things are just going to be delayed. And so that puts angels in a tough situation where they're deciding whether to fund their existing portfolio companies or invest in new opportunities that are coming to the table. Another effect of economic uncertainty on angel investors is that the declining public market value right now has a real effect on the wealth of individual angel investors, and that's going to have an impact on their decision to invest in high-risk early-stage companies. So if you're an early-stage entrepreneur that's seeking capital at this time, you may want to consider a few things. First and foremost, it's going to probably take longer than you expected. Okay, that's just the reality of the situation. When you engage with an investor or an investment group, I would recommend that you ask them if they're still investing, and if they are investing, in what type of deals are you investing in. If it's a fund, like Mark mentioned, if it's an early stage angel or venture capital fund, you may want to consider the stage of the life cycle of the fund, because if it's later stage, they're going to be reserving dry powder for their current portfolio companies, and that might not be the best target. But despite all these challenges that I'm kind of laying out here, there is some optimism here, and it's a really good time to engage with investors and begin building relationships with folks so that you might be first in line when things do return to normal. I think it's also a really good time for innovations that may have an impact or a really impactful business model given our new realities with COVID and what's happening. So when you start looking at the entrepreneurs that we typically work with, the entrepreneurs that we talk to are doing what they do best. They're finding creative ways to survive and thrive in these challenging times. We're finding that many companies are doing interesting pivots to be able to respond to COVID and provide support right now. The companies are really focusing in on their business fundamentals, looking at keeping a close eye on their financials, managing cash flow, reducing their burn rate, extending their runway in whatever way they can, and being creative. But one of the things that I've really been focusing on when I've been talking to companies lately is reframing your communication. And so it's really easy to kind of get negative and feel negative about what's happening. But I think more importantly than ever right now is for companies to demonstrate maturity and confidence when they're laying out a new plan and communicating with their employees, with customers, with investors or potential investors that they might approach over the next few months. So given all this uncertainty and the likely decline in the overall equity investing landscape, I think now more important than ever is to be creative, to really find creative ways to bootstrap your company, to get early revenue into the company. If you're a company that's raising R&D capital, now is a good time to reconsider SBIR and STTR funding as part of your strategy. The SBTDC provides a tremendous amount of support around to help companies that are going through the process of assessing and raising SBIR and STTR capital. So we're happy to talk to you about that. Now is also an important time to be looking at some of the SBA lending programs that are available to small businesses. The economic emergency and disaster loans, as well as the PPP programs that I'm sure everyone is familiar with. The SBTDC has done a tremendous amount of work and is really on the front lines of helping companies to evaluate these programs and understand whether or not it might be a good fit in your situation and help you apply to these funding programs. You may have heard that both the disaster loan and PPP programs were refunded by Congress yesterday. So there's going to be a lot of new information coming out, and I would encourage you to look at our website, sbtdc.org, where we have a lot of information about these SBA funding programs. So with that, I'd like to turn this over to question and answer discussion with our investor panelists. Again, we appreciate you guys being here. And I think the first thing that we should talk about is maybe what is your typical investment thesis? You've talked a little bit about it, but in normal times, what is your investment thesis within your own groups? And then how do you see the changes that are happening right now impacting the long-term and short-term kind of investing activity within your groups? Anybody want to take that one first?
Sure. Yeah, I'll be glad to start. I'm glad you said normal times because I'm not quite sure what we define today as. You know, you hear a lot of people talking about the new normal, and you know, one of the things I'll preface my comments with is that unlike any other time, possibly other than 2008 during the Great Recession, you see people changing their moods on a daily basis. It almost parallels the changes in the Dow Jones Industrial Average or the S&P 500. There's such radical swings, and people are currently going from optimism to pessimism. And you know, we've got this virus sitting out there that nobody really totally understands, and we've got a foggier crystal ball than I think has ever been there. So you may talk to somebody on one day and get one answer. You may talk to them again 2 days later and get a different answer. So I think one of the things is persistence, and you know, something that's been true forever. When an entrepreneur hears no from an investor, it does not mean you have a bad idea, a bad company, or you're a lousy entrepreneur. It just means at that particular time, for whatever reason, you don't match what that investor is looking for. And that's important to keep in mind, and also important for an entrepreneur to be able to keep up their spirits as they go looking for that, looking for those investments. And under the best of times, raising money is not fun. So it's more difficult today than it was. And back to your question, what's our general investment thesis? We typically at RTP Capital look for early stage companies. We rarely do anything past an A round. Most of the things we look at are Series Seed. Very often they come to us as convertible notes, but we definitely prefer equity rounds. Generally, we like to see some level of revenue. We're not looking at pre-seed companies. And we look at a wide variety of industries. As a network with 60 members, we've got a lot of diverse interests. So we try to bring in deals that would be interesting to subsets of the group. We're never going to have something that's going to be interesting to all 60 members. But we've looked at things in agriculture, we've looked at consumer goods, but by far, mainly because of the part of the country we're located, the two things we see more than anything are life science deals and IT deals. And on life sciences, we generally will not look at pharmaceutical deals because they don't make typically good angel investments. They need lots of rounds. They have a long period to be able to go forward. And very frequently, the angel investors are going to be scared of dilution and being washed out as those rounds go along if they can't afford to keep up. So that's an overview.
Yeah, great points. So Eva, one of the questions that's come through that I think will resonate well with this question that I've asked is for pre-seed investments within the launch place. Do you fund at the idea stage or at the research stage? And kind of what are you guys looking to invest in at early stages? So that kind of goes along with your investment thesis overall.
Right, thank you for that question. And I'm going to give the answer that I hate to give. It depends, because our seed fund and pre-seed investment committee takes each and every application to our fund case by case. But ultimately what we are looking for is a company or a startup that has a prototype or very close to a prototype, but needs additional refinement, needs additional cash infusion to validate the prototype, or if they already have an MVP, they need additional market validation or third-party industry verification of the technology being a solid one. But we also have invested in companies that already have had an MVP. However, they needed additional support in terms of figuring out the scale up or how they're going to go to market with limited funds. And these companies typically either have a good product or a semi-good product that is ready to be launched, or they have a good management team and they are still trying to figure out the next course of action. So when it comes to pre-seed, and I just need to give you a historical perspective, first we started when we raised our first $10 million in 2012 from our anchor funder, the Danville Regional Foundation. We started with the seed fund. The pre-seed fund was created 2 years later when we saw companies who were either had good teams, good products, great market, but they were missing key pieces. We didn't just want to let them go and say, come back to us 6 to 12 months from now. But we knew that just by infusing $25,000 to $75,000, we will be able to answer some of the basic questions and help them answer those questions. So when it comes to the pre-seed, it really depends on the industry and on the company and where they are. But we have a motive. In order for us to fund the company through the pre-seed fund, our motivation is that the company is going to meet the milestones. And once they meet the milestones, they will get additional funding from the seed fund. That's the premise.
Outstanding. And I think that answered quite a few questions I see coming through right now. So thank you.
Mike, can I jump in with one other quick thing? One of the things I probably should have said, part of our criteria has always been and will always be, how do you ultimately get out of your investments? We try to stay away from what's called lifestyle companies. And, we could have a whole discussion about lifestyle companies and how those are still entrepreneurs. But for an investor, you have to have a way to get out at some point and hopefully a fairly clear path for that exit. One of the investment challenges today is that nobody really knows what those exits are going to be like. And a lot of the current portfolio companies are going to have prolonged exits. Because of that, as you mentioned before, there's a mix of how much people want to have invested in any given asset class. And if there are going to be investments that are taking much longer to exit on the private side, that's going to have an impact as to how people look on new investments.
So Mark, do you, among these challenges that you're talking about, do you also see opportunities for investors and entrepreneurs in these times? And what kind of opportunities do you see your own investors looking for right now?
Oh, absolutely. I think there's lots of opportunities out there. First of all, the new normal has created all kinds of different opportunities. We had talked to a company not long ago that was in the electronic delivery of college curriculums and actually assistance with college curriculums. It was a nice business model, but in today's world, it takes on much more significance. So there's a great opportunity there. We've seen a number of different companies that have pivoted to try to address things in the current environment. But aside from just the current environment, what it really does is give an investor a chance to see who as an entrepreneur is a leader. Because you want to be able to invest, it's the old story of, do you invest in the jockey or the horse? And you always want to invest in the jockey. You want to make sure the horse is a good horse, but that jockey is so important. And there are a lot of young entrepreneurs in the area, and not having experience with things like this is okay. But knowing how to ask the right questions and give confidence that you're not going to go into these uncharted waters just by yourself, but are going to seek advice and not listen to all the advice you get, because you get advice all across the board, but at least be able to cull the advice and come up with decisions that people are going to be confident about, I think makes investors much more comfortable going to bat with that with that company and that entrepreneur.
Yeah. So I'm seeing a question here from several folks, a trend, and there's some life science investor companies on the call today, and they've got some questions about if they're a therapeutic related company. Given Mark what you said earlier, does it make sense for them to spend any time focusing on angel investors, or should they go directly to later stage venture capital funding or other opportunities?
Well, I think that depends on what group it is that they're talking to, and also what stage they're in. Is it a therapeutic that's out there and they need additional money because they have something that's going to be able to be used in the current environment? Well, angels could react pretty quickly, and there's a lot of angels that are really interested in finding ways that they could react to something and make an investment in it. One of the things Eva and I have done together is put together a group of the leaders from different Southeast angel capital groups. And we have about 35 people that are part of a weekly call right now. And we're looking specifically at ways that companies that are in need of current financing, because they're helping in the societal battle against coronavirus, find that funding. So there are lots of ways, and it may not be directly through RTP Capital or through the launch place, but One of the things about the Southeast, we saw this last year when we hosted the Southeast Regional Conference for the Angel Capital Association. This is probably the most collaborative area in the entire country. We know all of the groups throughout the Southeast, and the Southeast runs from Virginia down to Florida and across to New Orleans, kind of an extended Southeast. Every once in a while, we even put Texas into the Southeast. So it may not be us directly, but if it's something that we might be able to help, we're happy to do that.
And just to add to that, it depends also what type of therapeutics you do have. If you already have a product that's already on the market that creates opportunities for immune system boosters, that's definitely an area where we are looking at together with our other syndicate partners. We have several portfolio companies that can address that need. But if you have an idea, or not just an idea, but you already have a product that can help with COVID-related illnesses, we definitely take it into consideration, and we are still accepting applications, new applications in the industries that are either directly related to COVID or can increase sales because of the products and services that they are providing. So therapeutics, again, depending on what the therapeutic helps or solves, can be a very interesting opportunity for the investors who are still in the marketplace.
Yeah, one thing the people on the webinar should realize, when you go to talk to angel groups, make sure you understand what that angel group invests in. If it's a group that only looks at IT deals, you're wasting your time to go to them with the world's, if you had something that's guaranteed to cure COVID tomorrow, they may kick themselves that they couldn't invest in it, but if they have a set of criteria that says we're only investing in computer companies, you're not going to get through to them, so you're wasting your time with that. So know what the individual groups focus on.
So Eva, Mark mentioned that things kind of seem to be fluctuating with the Dow Jones Industrial Average and moods on a daily basis. Are you seeing that as well? And how did these recent public market volatility translate to decrease in investor appetite for early stage investments?
So I think there is a little bit of difference between networks versus funds in the angel investing industry as a whole. Networks do need to have capital calls in order to fund different deals that they are screening, versus if you are a fund and you have just raised your current fund pretty recently and you have substantial amounts of money to still invest, that's a different scenario. We are still, just like I said, we are still screening companies in growth industries. We are not making new investment decisions within the next 90 to 120 days in companies that are not related, or they are not solving either COVID-related issues or societal change issues. But as a fund, we don't have to go out and have a capital call each and every time when we are considering a new decision. So on one hand, right now, if you're talking to an angel fund, it might be more beneficial to you. On the other hand, if you are a network and there are several interested investors within your network who happen to be experts in infectious diseases, you still might get some luck. But ultimately, I think at this point in time, funds who have been able to raise funds earlier, prior to the pandemic, and they have disposable investment funds, they are still looking at deals at the growth industries. Having said that, I keep emphasizing the fact that all of us talk. We have these weekly meetings throughout the Southeast, but also in North Carolina and Virginia. We are working with our co-investors, whether they are funds or networks, and we are really trying to make sure that A, we are first and foremost helping our portfolio companies, but B, also there are some deals in the pipeline that we either had done due diligence on or made investment decisions on, that those still carry on. And also, if you are a fund who just finished raising and you have the capital available to fund, we definitely are working with our partners to make sure that if and when there is a company that's really growing and needs infusion of capital, we can come together as a syndicate and still carrying on funding these companies.
Great. So I'm seeing a lot of questions here, and I'm doing my best to try to field as many of these as possible. Again, we'll get back to people with answers if we can afterwards. But I am seeing quite a few questions about kind of the difference between the angel perspective and the venture capital perspective right now. So I'm wondering, Eva, if you might be able to elaborate kind of what makes venture capitals comfortable with the company in normal times, but also kind of what you're seeing now and how that compares to angel investors.
That's a really great question. And we always try to work with our venture capital friends who are investing in our portfolio companies in follow-on rounds. And there is even more collaboration now. So I'm not an expert in venture capital. I can only talk to our syndicate partners or venture capitalists who had ended up investing in our portfolio companies. And I can say, just like in our case, at the launch place, we are an angel fund. Also, our partners who are co-investors in some of our portfolio companies are doing exactly the same. They are trying to make sure that their existing portfolio companies, the ones that they still have a marketplace, get enough funding to get through this pandemic, and more importantly, also potentially infuse additional capital to those portfolio companies that have products and services that are needed right now. So there is a much bigger, not bigger, but much more intense cooperation between angels and VCs when it comes to existing portfolio. When it comes to new deals, just like us, the VCs that we are working with are also looking for longer runways. They are looking at very trusted referrals in the industries that are growing. And they are not making rush decisions, just like we are not either, but that's not to say that they are not screening companies. But the priority right now, whether you are an angel network, angel fund, or VC, definitely throughout sectors, throughout geographies, what I'm seeing is everybody's focusing on helping existing portfolio, but also making sure that we still pay attention to new companies coming in and at least have a preliminary conversation and get them into the queue. But that doesn't mean that we would make an investment in a new company within the next 90 to 120 days.
Got it.
Mike, could I add something to that?
Sure.
First of all, I totally agree with what Eva said, but I think one of the things that's still to be borne out is what's going to be the impact on valuations. The angels and VCs both care deeply about valuation. VCs are probably a little tougher on valuations. And the Angel Capital Association is having its annual meeting, which has been moved to virtual, coming up in another month. One of the topics for a roundtable that I suggested was a discussion among angels as to what do you do about valuation? Because you've got an issue that sits there sometimes. You know, for instance, if the launch place has invested in a deal and they're at X, and we're looking at investing, or somebody else is looking at investing, and because of the COVID environment, we can get away with having that at X minus 50%. Well, we hurt the launch place, who is a partner with us in a lot of different deals. And where is that responsibility? We've got a fiduciary responsibility to our members to try to get the best deal in a company. We also want to have entrepreneurs that can stay with a substantial portion of their company so they stay motivated, and we don't want to hurt our partners that we invest with in other deals. So there's a real dilemma that sits there, and I think that's different among angels than it is among venture capitalists.
I agree.
Great point.
Mark, you jumped into the next question about valuations.
Oh,
Yeah,
sorry,
yeah.
I haven't looked down at the list.
Yeah, I see we're getting a lot of questions about valuation and kind of the current trends. I know, Eva, you know, we've had discussions about valuation before. I know it's an important topic, obviously, and something that folks get the most excited about. So I'm hoping that maybe you could provide some insight on where valuations have been and where they may be going as a result of COVID.
So historically, I firmly believe, and I might not just be the only person on this call who shares that same view. I think some of the angel deals, seed and even pre-seed deals, were overvalued. The launch place actually had conducted 6 due diligences earlier in 2019. And we walked away from it because simply the valuations were just so unrealistic for our marketplace. So when it comes to valuations, I think there is going to be an adjustment. It's still too early. What's going to happen are companies that are really addressing needs in the growth markets right now because of the pandemic. They have products and services that can really help to solve the overall issues, might demand higher valuations that they would have done 2 years ago. For example, we have companies that pitched to us 2 years ago. They were too early, we did not agree on terms, or they couldn't agree to Danville economic impacts, but right now they have a service or a product that is very, very high demand. Those companies most likely can demand higher valuations. When it comes to companies that are having marketplaces that we really cannot assess whether the growth, the revenue and sales projections are still going to be there, compared to January when they pitched to us, or February, those we are putting on hold. Overall, I think there is going to be a much longer time to figure out valuations than the 3 to 4, 5 months period. And I can't sit here and say all the valuations are going to go down or all the valuations are going to go up. I just do know some of our portfolio companies that are in the middle of raising might have some difficult conversations about adjusting their valuations, or even companies that were planning going out and raising money from either angels who are still playing in the Series A or trying to go to VCs. But there might be some haircuts happening in the future. But again, I don't like to give fuzzy answers, but it really depends on where you are in your company's development, what's your revenue, what kind of dry powder you have, but ultimately, are you really providing a product and service in the industry that is still needed? And if you are, and especially if you are in an industry that is growing, the conversations might be completely different versus companies who are really struggling to maintain their market penetration.
Yeah. So I'm hearing that there's a real risk at this point for companies that have currently raised capital. There's down round risk here that they could end up having to raise capital at a lower valuation than they previously did. What advice might you give for a company like that in preparation for reaching out to investors and communicating with them about this potential situation?
So the answer would be twofold. For those companies that are currently raising and they have a set of existing investors, the best way to raise that money right now is going to go back to your existing investors versus trying to reach new sources of funding. When it comes to companies that have been planning to raise, starting to raise in June, July, I would hold off on that. Because simply these questions, what you are asking exactly about valuation, but most importantly for us, for our research analyst, is valuation is one question, but the second, or even prior to valuation, to us, the most important question is, how do we assess market potential? How do we set acceptable, semi-realistic numbers for sales and revenue projections? And it's very difficult for us, whether you're a fund or a network or a VC, to even give guidance to companies what variables should be going into revenue and sales projections. But having said that, none of our portfolio companies have completely shut down fundraising, but the best thing to do is really reach back out to your existing investors. And if you are a new company, you still might want to reach out to funds and networks, get in the queue, which I don't like to use that term, but this is the time to still establish those relationships. Yes, we cannot meet in person, but we can have Zoom calls. We are very transparent. We don't promise that once you apply within 90 days, 120 days, you're going to get funding. But this is the time when we can do at least some type of due diligence on the team. So I wouldn't shy away at all reaching out to funds and networks that you already have had on your target list.
Awesome.
Yeah, I agree with Eva completely. And, you know, there are a lot of companies that have gotten funding over the years that vanish sometimes after they get that funding. And if you just all of a sudden show up and say, hey, I'm here, I'm out of money, do you have something you could write me a check with? The answer is probably going to be no. It's a perfect illustration of why we always tell entrepreneurs, stay in touch with your investors, keep people updated, over communicate, even if it's bad news. Don't be afraid of bad news. Very often you have investors that want to help you with that bad news. They're not going to shoot you for the bad news. So make sure you stay that course. And getting in the queue, I think, is very valuable advice for people. You know, it's hard for entrepreneurs right now to network. And there's definitely a difference between a warm introduction to a fund or a network than just sending something in through Procedure or whatever the application process might be. It's harder now to do that, but it's not impossible. And it's definitely worthwhile.
Mark, can you talk about some of the kind of social groups or meetup opportunities given normal situations for entrepreneurs that are hoping to interact with investors and get to know them?
Sure, and there's a ton in the triangle that go on under normal circumstances, and hopefully we get back to them. You know, American Underground has things all the time. HQ Raleigh has things. There's Startup Summit. Bull City Ventures runs a meeting every year. Those are all great places to rub elbows with potential investors. And you can't start too early. When you have a kernel of an idea, talk to people about it. Get on their radar screen. So when you do actually apply for funding, they know who you are. And we get, under normal times again, we get dozens of applications a month. Many of them from all over the place. They, you know, as I said before, they don't read the criteria for what we're looking for. And the same thing happens with Launchplace. The same thing happens with co-founders and whoever you want to talk to. It's hard to cull through all of those. But if Mike Carnes has a business that he's thinking of starting and he starts talking to me, and when it comes time for him to fundraise, he just drops me a note saying, I'm starting to fundraise. I say, go ahead and put it into Procedure. I'll tell our screening committee, look for Mike's business plan, and it's going to get a better review.
And also, if I just might add, some of us who actually do have entrepreneurship support services, such as we are organizing different competitions. We have Idea Fest and the Big Launch Challenge. Unfortunately, because of COVID-19, we had to postpone our Idea Fest from April 2nd. We are hoping to hold it in one shape or form sometimes in the fall. That needs to be still worked out. But during normal conditions, during normal times, attending these pitch competitions would be a really great way to meet investors and startups. But now, since life has changed, most of the pitch competitions are moving online, just like this webinar. Most of the investors in our network partners are more than willing to talk to startups still. So whilst we might not be able to see each other at Idea Fest, hopefully the Big Launch Challenge will be live, but I can't promise that. But attending these seminars and reaching out to investors who are on these panels. Monday, I was invited to provide input to some student classes at Duke, at UNC, and those student teams that are looking for funding, and they might not get it for the next 6 to 8 months, they have access to us. So I'm just encouraging people not to completely shut down, but really reaching out to us, because whilst we are, I keep emphasizing it, we are focused on our portfolio companies, but we are still screening companies and we are talking to them. So for example, a webinar like this is a perfect place to meet investors.
Yeah, it's awesome.
Yeah.
So
And entrepreneurs are very resilient. Things like Idea Fest and Launch Place, even if you're not raising funds yet, or you're not even starting a business yet, go to those, see who wins those competitions and what they did to get the judges' attention. It's a great learning opportunity, and they're really a lot of fun.
Yeah, that's awesome. So unfortunately, we're running up against time here, but what I would like to do is I'm looking at the questions. We've gotten, I don't know, well over 30 questions here, and I know we haven't been able to get to all of them. Some of these are really kind of nuts and bolts logistical questions about raising capital, about, you know, how is valuation determined, all these types of things. And so I would really encourage folks to come to our Investor Ready Entrepreneur program. I'm plugging, you know, shamelessly plug self-promotion here, but I think that it's a great opportunity to learn about the nuts and bolts of the raising capital process. And we bring in investor panelists just like this to have the discussion. It's a full day workshop, and I think you'd get a lot of value out of that. So for a parting thought here, I'd like to just maybe turn to Eva and Mark for one last question. Maybe what perspectives or recommendations in closing you might have for entrepreneurs who are currently seeking capital, who may, you know, have had plans to raise capital, but now are confused as to whether or not that's actually going to be able to happen.
If I may, I would just suggest don't stop reaching out to us. Again, our focus right now is portfolio company help, but we are still screening companies. And especially if you have a product and service that's in high demand and you need to increase capacity in order to meet your high demand, Angel Networks funds are ready to talk to you. We are still very actively generating deal flow. I cannot promise that if your company is not addressing one of the sore points related to the pandemic, that you get funding anytime soon within the next 3 to 4 months. But even in that case scenario, reaching out, talking to us, understanding what our internal struggles are, because believe it or not, we also are managing funds and we need to make sure that our funds allocation is in line with our mission. But just establishing those relationships early on is still valid, very valid. But again, if you are in an industry that's really has answers to the pandemic, or your specific company or idea can potentially help not just addressing the pandemic, but also the consequences of societal changes, you will be fast-tracked. So I would like to encourage everybody to not stop reaching out, but if anything, just like Mark had said previously, over-communicate.
Great points. Mark, do you have anything in closing?
Yeah, I'll first of all, I agree with everything Eva just said. I will give a counter to that that's on the pandemic side. I can't tell you how many different entrepreneurs I've seen decks from in the last 3 weeks that did not address the current environment. They just have a deck like everything is normal. And everything is not normal right now. Whether your business can go through it as if it was normal, or if you have a delay in whatever you're doing, address that in the information that you're providing. Because if you don't, we look at it and say, what world are you living in? And if you're ignoring something like coronavirus and the impact on the world, what are you doing about other parts of your business? So it's really important to address that. The other thought I would leave you with is everybody that's an entrepreneur is an entrepreneur because of certain characteristics. Use those characteristics, your stick-to-itness, self-fortitude that you have, and the belief in what you're doing to get that through to people that may be investors. And it may not be today, as I said before, no doesn't always mean no, it's just no at that particular point in time. And continue pursuing your dreams. Great
advice. Well, thank you both for being here today. We really appreciate you guys being flexible with the webinar. I think it's been a great opportunity to get some answers to folks' questions. We appreciate everybody for attending today. I hope you got a lot out of this webinar. Again, we're going to try to follow up with questions that didn't get answered, and certainly feel free to reach out to me if you have additional thoughts or need feedback from us. Thanks a lot, guys.
Thank you, Mike.
Thank you for the invite. Bye.
Yes. Stay safe, everyone.
Bye-bye.